What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and today we are discussing Japanification, and we're going to debunk that myth. A lot of people have said for a long time, just look at Japan. We can print as much money as we want. We can, QE can go on to an infinite amount. We can expand QE. The Federal Reserve can monetize much more government debt. Federal Reserve's balance sheet has a huge way to go before we ever get to what Japan has gotten to. And they've never experienced inflation, and they've experienced some deflation and some stagnation. So basically the argument is just look at Japan. We can print as much money as we want. It won't cause inflation. So today we're going to look at a couple of things because quite honestly, the Japan story is like an iceberg. All we see just by that explanation, that quick argument, is just the very tip. And if we dive in a little bit and look underneath and look at the details, we can see that what Japan has done is vastly different than anything that the United States has been doing. And the story is not actually as simple as it seems, that they've been, printing a bunch of money without causing inflation. And the source for this video today is Lyn Alden. If you're not familiar with Lyn Alden, she's a fantastic investment strategist, research analyst, and she's got a website, lynalden.com. You can find her on Twitter. I'll link those in the description below. And pretty much every time she comes out with an article, I usually throw it in my weekly newsletter. I've got a weekly newsletter every Friday. You can sign up in the description below. It's free. And I just put in a couple of articles every week that I've enjoyed, that I've read, that have been very good or helpful or educational articles for me. So if you'd like to sign up for that, you can do that in the description below. So without further ado, let's debunk Japanification. Ready? Let's dive in. All right, so we all know the narrative that Japan basically printed as much money as they could, as they wanted to, and they never had any inflation. And the argument is even goes so far as to say, hey, look, they were trying to cause inflation and they weren't able to, no matter how much they tried, no matter how much the Bank of Japan's balance sheet grew. Now, it's true they've had some pretty big stagnation. All we need to do is look at this chart of their GDP, and we can see that for decades, it's basically moved sideways. No real growth there. Now, this story, we have to go back a little bit in time, look after World War II. We all know that after World War II, the whole world basically tied their currencies to the dollar. The dollar tied its currency to gold. So everybody in the world was like, hey, that's a great arrangement. We don't need to have the gold. We'll just use dollars. And at any time we want, these are our dollars. We can go turn them in and get our gold back. And we all know what happened. 30 years later, America had printed way too many dollars. There was not enough gold in the vaults to back up all the dollars that we had spent. And so everybody tried, there was a run on the bank. Everybody tried to get their gold. And then Nixon just said, no, we don't want to give you your gold. And so from then on, there was a little bit of economic turmoil globally because countries were trying to figure out, how does this whole currency thing work? Because up until that point, for thousands of years in history, there's been a gold standard somewhere. And so it was really just somewhat of a turbulent time as countries were trying to figure out, hey, how do we deal with this whole currency thing? And so obviously the United States wanted to keep front and center with keeping the dollar demand up globally so that people would keep on using the dollars. So the petrodollar system was rolled out, which led to the fact that the United States really had to roll out structural deficits in order to maintain global demand for dollars. And by the way, as we're going through this, you're going to hear me say deficits a lot, and there's two types of deficits. There's a trade deficit and there's a fiscal deficit. Trade deficit is like, hey, our country versus your country. We're selling you more stuff than you are selling us stuff, or in general, let's say the United States is buying more stuff from all other countries combined than we're selling to other countries. So that's a trade deficit. And the opposite would be a trade surplus, that other countries are buying from us more than we're buying from all other countries put together. So that's trade surpluses and deficits. The other type of surplus and deficit is like a budget deficit or a budget surplus. So the government, how much money is the government spending versus how much money the government is bringing in. Just like when you spend money on a credit card because you ran out of money at the end of the month, and you spent money on a credit card to pay buy your groceries for the last part of the month. You ran a budget deficit that month because you spent more money than you brought in income. Same thing with the government. So the United States had to turn, and we had to start running trade deficits. And the other thing that flipped over time was that the United States turned from a creditor nation into a debtor nation. So At that point in time, the United States was owed more money by the globe than we owed to the globe, or owned financial assets. Most of that's debt, and we flipped. And so now the rest of the world owns more United States assets. We owe more money to the rest of the world than they owe to us. Now, certain things like this are zero-sum games. So like global trade deficits and surpluses, those things are zero-sum on net, because not everybody can run a surplus. Now, that doesn't have anything to do with whether there's growth or decline. That's just the balance of trade globally. So when the United States switched from started running these massive trade deficits every single year in perpetuity, that opened up the opportunity for other countries to step in and run trade surpluses, and one of those countries was Japan. In fact, if we look at this chart, we can see that it's very rare that Japan ever runs a trade deficit. They're usually running decent trade surpluses. Now, 1980s rolls along, Volcker's trying to crush inflation, and this caused a problem with global currencies again, because as interest rates spiked, that means the dollar started weakening versus other currencies around the world. This poses a problem for Japan, who runs a trade surplus. It made their exports less competitive. So in response, Japan rolled out monetary easing, fiscal stimulus, and financial reform. Now, these three things put together formed one of the biggest bubbles in history, and most people don't know about this, but Japan in the late 1980s had one of the biggest bubbles in history, and it wasn't just the stock market and it wasn't just real estate. It was both at the exact same time. And so like when we look at the at a big stock market bubble, we usually look at the dot-com bubble. Valuations, that bubble in Japan in the late 80s was much more severe than the dot-com bubble during 99, 2000. Similarly, their housing prices, their real estate bubble, was actually larger than the United States real estate bubble in 2007, 2008, and it happened at the exact same time as the stock market bubble was happening. In fact, if we look at the numbers, Japan's land was worth total. Japan's land was worth total a little over four times more than America's total land value put together. But the United States is 25 times larger than Japan in terms of land mass, and so when you put the numbers together, that means like per square foot, per square mile, Japan's real estate value, their land value, was 100 times more expensive than the United States at that same time. So their real estate bubble and their stock market bubble was way bigger than what we experienced at separate times here in the States. Now, this bubble crashed and the asset prices crashed, but what did not accompany the asset bubble crash was an economic crash. Instead, it was kind of just a low slump. Their unemployment stayed low, under 6%. And while you can see here this big, the bubble and then the crash and then the slow decline in asset prices, this is their stock market, you can see that it did not lead to a giant economic depression. Now, at the same time, their population had peaked and started declining, and so that is a negative factor when you're looking at growth as well, because you need demographics. Demographics are like one of the number one drivers of growth. You need a growing population to support growth. When you have a declining population, it's really hard to continue growth, and so that is when their population had peaked as well, right around the same time as the air started coming out of their their bubble. The bubble started crashing, and then they entered into the slump. Now, this right here, this moment, this is when the argument really starts. Because at this point, they started printing a ton of money, they started monetizing their government's debt, they started rapidly expanding their central bank's balance sheet, and they couldn't cause inflation no matter what they tried. If we take a look at their balance sheet, you can see it's a vertical line. They've increased their balance sheet far more than other central banks have increased their balance sheets. In terms of percentage, their balance sheet is 130% of their GDP, which is way bigger than the Federal Reserve's balance sheet right now compared to our GDP, which is about 30%. And still, even though they ran large fiscal deficits, they monetized that debt, they bought equities, they still had deflation. So there was no major devaluation of their currency versus other currencies despite them doing all this. Now, here's the biggest key here, the biggest takeaway that is important to understand about this. There's a massive difference between base money and broad money. If that's the only thing you take away from this whole entire thing, that's the key and that's the difference. Base money versus broad money. Base money is defined a couple of different ways, but the easiest way to understand it is bank reserves. It's the amount of money that banks have in their reserves. Like in the olden days, it was the amount of gold they had in their vault, but it's the amount of reserves that they have. That's base money. That's not money that's in circulation. That's just the money that is used as the base layer. Broad money is the money that's in circulation. It's the money that's in checking accounts, basically. Now, broad money is almost always many multiples of base money. And the reason that is because of mostly bank lending. A bank has, let's say, $100 in reserves. They can lend out, $1,000 on that $100. So if somebody comes to get a loan, when you borrow from a bank, when you run your credit card, when you get a car loan, when you get a mortgage, you're not borrowing money from, John who has a CD or a savings bond. You're not borrowing money that was already in existence. You're borrowing money that's newly created through the fractional reserve system. It's expansionary bank credit. Money comes into existence through loans. So that's the difference between base and broad. We'll come back to that later, but base money is basically bank reserves. Broad money is what's in circulation, like in checking accounts. This is important because let's say the Federal Reserve expands its balance sheet. That doesn't mean that your bank account balance goes up. So by itself, there's no direct increase in broad money just from an increase in base money. And this is the reason why a lot of people say QE is not inflationary, because strictly by itself, per definition, it's not. So it really depends on fiscal policy, which we'll get to, which is basically what is the government spending their money on. That's what really matters here. It's where does that money go when the Federal Reserve or when the central bank expands its balance sheet, when base money increases, what is the result of that? Where the multiples of that going? Now here's where we start to get into the myth busting part of this. The narrative is that Japan has printed money and never been able to cause inflation. They printed more than anybody else. Well, we know now that there's a difference between broad money and base money, right? If base money is increased, they just print a bunch of bank reserves, but the bank lending doesn't go up, and there's not more money in people's bank accounts. If broad money doesn't go up, just base money, then there's no more money actually in circulation. It didn't have any effect. It's not an actual increase in the money in circulation. So there's not going to be inflation from that. So we have to look at broad money. So who do you think has had the most broad money expansion over the past 20 years? Contrary to popular opinion, it is not Japan. If you take a look at this chart, it's the dollar, and especially recently, it's started to turn vertical. But the broad money increase in the dollar has far outpaced the broad money increase in Japan. It's even outpaced the euro. And I know what you're thinking, because this was my thought as soon as I saw this chart. I said, well, control for population. What is this, instead of on an absolute basis, what is this per capita? Well, I'm glad you asked, because the United States, 6.2%, the annualized rate of broad money supply growth. Euro is 5.5%, and then Japan, 2.9%. Japan's broad money growth has grown at under 3% annualized for 20 years versus the United States 6.2%. Base money increase is the same thing as printing money and throwing it on an island or, putting it on Mars. Broad money increase is the money that's actually in circulation. So now we have two things going on here. We've had massive base money increase by Japan that has led to almost no or very little comparatively and absolutely a broad money increase. Versus America, our base money increase hasn't kept pace at all with Japan, but our broad money increase has far outpaced Japan. So we know that the result of a broad money increase is not directly tied to the base money increase. So we know that you can have drastically different amounts of base money growth versus broad money growth. So if base money growing by itself doesn't absolutely and always, as an iron law, increase broad money, what is the correlation there, and what is the relationship? How does broad money grow? Well, there's two ways. Number one, bank lending. Number two, fiscal deficits. Now, with bank lending, it's absolute or total net bank lending. And so if you have an increase in bank lending over here, but over here you have a lot of people paying off their debts, then on net, you don't actually have an increase in broad money, because you have to look at the whole entire system. And so if you have a lot of people deleveraging, a lot of companies, taking down the amounts of paying off debt, people paying off their credit cards, if you have a lot of saving, things like that, that's actually going to produce deflationary pressures, because it's destroying money. Remember, broad money is the amount of money that's in circulation. And so if you take money from your checking account and pay off your credit card, now there is that much less money actually in the system, because when that money came into existence, it was loaned into existence. It didn't come from somebody else. So the money supply grew when you ran that credit card at the grocery store. Then the money supply decreased when you paid off that credit card loan. So bank lending is one way that base money would translate to a growing broad money supply. Now, fiscal deficits. This is the other way that broad money supply will grow. And there's a couple factors to make sure that actually is the result. Number one, if you want your broad money to grow, and you're trying to do that by having the government spend more money than they take in, obviously that's going to have to be through borrowing, because when you're running a deficit, you're not taking in that money from taxes, so you're going to be borrowing that money. The key is that money that you're borrowing to cover the shortfall between taxes and expenses, that cannot come from the economy. You can't be borrowing from individuals. You can't be borrowing from institutions. You can't be borrowing from pensions. That borrowing has to be monetized by the central bank. Otherwise, you're taking money out of the economy over here and then putting it back in over there. And then overall in the economy, you didn't actually increase the total supply of money that's in circulation. All you did was take it from one place and put it in another. That's not going to contribute to a broad money supply growth. That's just going to contribute to redistribution. And so if the government is borrowing in order to cover their fiscal deficits, they have to borrow that money from the central bank, who is printing that money. It has to be new money coming into existence out of nowhere from that base money. And that's the reason why I've said for so long that in the United States, QE actually is inflationary, because look what the government is doing. They're spending that money. They're borrowing a lot, not from citizens, not from institutions, they are, but the vast majority of where they're borrowing from now is coming directly from the base money expansion, from the Federal Reserve, monetizing that debt, from printing that money out of nothing. So how much then did the United States increase their broad money supply by? 25% in the last year. Within the last year, broad money supply grew by 25%. That's the biggest one-year increase since World War II. Now, I said earlier, there's two ways that you grow broad money supply. It's by bank lending and by the fiscal deficit. Well, we didn't really have a lot of bank lending. And so the government really kind of just stepped around that and said, well, if banks aren't going to lend, we want to grow our broad money supply. We're just going to start sending helicopter checks. Well, that works. And that's literally taking newly created money and putting it into people's checking accounts, into circulation. That's a broad money supply growth. Now, 2008, 2009, the result of the financial crisis, I'm not making a value statement here. I understand. I disagree with the way that it was handled. You're not going to have a broad money increase when you bail out a bank, as you will by sending helicopter checks. You're going to increase base money doing that by bailing out the banks. You're not going to directly increase broad money. Normally, the United States has their broad money has increased at around 5% annualized. It's recently that jumped up to 6%, like I showed you earlier, and that's because we ran a massive deficit, 15 to 20% of GDP, and so that increased the annualized rate of broad money supply growth to over 6%, because that massive percentage-wise compared to GDP, that massive deficit that we've been running. Now, 15 to 20%, contrast that with Japan, has never run, basically never run a deficit over 8% of GDP. If you look at Japan's money supply growth, it never grew by more than 5%. Now, here's the final part of that equation, is that while the broad money supply was increasing by about 5% year over year, the private sector, the economy, was actually deleveraging in Japan, and it's been deleveraging for a long time. They've been decades of basically running budget surpluses themselves, companies and individuals. They've been saving, they've been paying off debt, they've been deleveraging. So what happens when total debt declines? That's monetarily, that's deflationary. That's money being destroyed. So there was an offsetting force of about 2% against the 5% broad money growth. That means that their broad money growth has been around 3%. So is it any surprise now that we understand what the actual numbers are? Broad money grew by about 3% annualized for the last 20 years because the private economy was saving and paying off their debt, completely deleveraging. And so of course there's going to be very little consumer price inflation. Now, the kicker here that really allows this is their trade surplus. Remember, I said at the beginning of the video, the United States has been running trade deficits for decades in order to continue trying to spur on global demand for the dollar, especially in regards to oil. Well, Japan has been able to run trade surpluses, and when you run a trade surplus, it really is going to provide a floor. It's going to create a floor underneath your currency compared to other currencies. And so you're not going to have any major room for any devaluation of your currency versus other currencies when you're running a trade surplus. So let's look at some things that are similar between the United States and Japan, and then some things that are different between the United States and Japan. Some similar things. United States and Japan both have been running fiscal deficits. Their government has been spending more money than they brought in from taxes. And they've both had a large increase in base money, although Japan's base money obviously has increased a lot more. And that's like the central bank balance sheet. Other than that, there's no similarities. So here are the differences. The United States has been running trade deficits. Japan has been running trade surpluses. The United States is a massive debtor nation. Japan is a massive creditor nation. The United States, we've got basically now no demand for our exports, which are treasuries. Japan has major demand for their exports. The United States has had massive broad money increase. The amount of money that's actually in circulation has increased massively, 25% just the last year, over 6% annualized for the last 20 years. Japan, on the other hand, the broad money supply has increased very little, both in absolute terms and relative to all other currencies. Their broad money supply has increased on absolute terms about 3% every year for the last 20 years. The United States has been levering up. Our debt has increased drastically. Our leverage has increased drastically. Whether you look at the government, whether you look at private individual citizens, whether you look at corporations, we are extremely over leveraged, and it's only been going in one direction. Japan, on the other hand, has been going the exact opposite direction. Savings have been going up, debt has been being paid off, and they have been deleveraging and destroying money at the same time as the central bank has been trying to create money. So, in summary, no. Just because the Federal Reserve is expanding its balance sheet and doing that by buying government debt, which means they're creating money out of thin air indirectly and then getting that money into the hands of the United States government so the government can spend that money on what they want. Just because that's happening doesn't mean directly that inflation is going to go up. Because in Japan, the way that their culture handled it, the way that the individuals had been deleveraging, what that money was being spent on, that meant that there was very little broad money supply growth. In America, though, our broad money supply growth has been exponentially larger and it has been growing. And so when the Federal Reserve prints money, when the Federal Reserve creates bank reserves, it's very different than when the Bank of Japan creates bank reserves. When we're doing it, we're spending way more on military than other countries. When we're printing money, we're spending way more money on healthcare than other countries. When we're printing money, we're spending a lot on helicopter checks versus other countries. So when you look at the numbers and the real data between Japan and the United States, it's very clear that number one, there are not really many similarities. There are way more differences than there are similarities. So we can't use Japan as an example of what the United States will turn out if we continue to expand the Federal Reserve's balance sheet, especially if we get anywhere near the point of the balance sheet size that the Bank of Japan's balance sheet is, simply because of what that money is going to and how that money is being spent. Because here in the States, it goes directly to increasing the broad money supply. I've got this article linked in the description below, in addition to some of the products and services that I recommend if you'd like to start moving some of your money outside of the financial system, outside of the fiat system. You'd like to start putting some money into gold, silver, Bitcoin, whether that's in storage or in an IRA, something like that. Go into my description below, check out my links, and some of them include deals for you as well, like $5 off for your first month free. As always, I really appreciate you guys. Thanks so much for watching. Have a good day.